well, there's a very risky loan, a type of mortgage that is rearing its ugly head again, and our real estate cycle is turning over again. And while a lot of people are expecting the Federal Reserve to just drop rates, they don't understand a whipsaw effect that can happen in the economy almost overnight. When I say overnight in the economy, we're talking about, a matter of 6 months, 8 months, that's going to put a lot of people out on the street because they started this type of loan. The type of mortgage we're talking about is adjustable rate mortgages. And if you've been timing when you're going to buy a house and what type of mortgage you want to get based on the rates and where the market's going, just so you know, the second it's going to seem like overnight, the Fed drops rates really in earnest. We're talking back down to where a mortgage is 4% or under. The prices of homes are going to whipsaw much higher. And the type of homes that are going to whipsaw higher are the cheapest homes in the market because that's where the fools are going to rush in. I don't want to see people get kicked out on the street because they can't pay their mortgage because then the Federal Reserve, because of inflation exploding higher, has to whipsaw and pump rates higher, just like what Paul Volcker had to do in the early 80s. So let's talk about this. I'm going to put a sale link down below to the Mortgage Master Course. It's $199, and this is what my promise is. If after 14 days you don't watch and go, I'm going to save so much more than the cost of this course, not only on my next mortgage or on my next refi, I'll give you your money back if you haven't watched more than 50% of it. But you're going to figure out real quick, there's no courses like this in the country. And it's very important that people learn all of the ins and outs, all the different types of mortgages, how to save money on specific things like all the fees that you shouldn't pay. Okay. So that link's down below. All right. So Wall Street Journal just came out with a story and it's entitled Risky Loan from Housing Bust Era is Making a Comeback. It says the unaffordable housing market right now is causing a growing number of home buyers to take on a type of riskier loan to cut their borrowing costs. It says here, and then I'm going to dive into what's wrong with this story. They are opting for the adjustable rate mortgage or ARMs. These loans initially offer cheaper borrowing rates compared with a fixed rate mortgage, but ARMs reset usually after 3 to 10 years, which can saddle borrowers with higher monthly payments if mortgage rates have risen over that time. So let me break down first something that people need to understand. There are, but they're very little used out there, just straight adjustable rate mortgages that adjust every year. There's usually what's known as the 3-5. There's still a 7. There are usually a 3-1 ARM, 5-1 ARM, 7-1, or a 10-1. I haven't checked to see which ones are very prevalent right now, but I'm pretty positive 3s and 5s are still the most widely used product, meaning that it's a fixed rate for a specific amount of time and then it adjusts. And what happens is a lot of people will get into these because the initial rate, called a teaser rate, is much lower than the standard 30-year fix. They get into that, they get into life, they forget the reset time. And by the time it goes to reset, the rates are much, much higher. Now, a lot of people are expecting rates to go lower in the near term. I believe that too, but I believe it's because of a crash coming in the stock market as the AI bubble is topping. We've got all these trade tensions and all this kind of stuff, and the consumer is completely tapped out. When that happens, rates will dive down, but I believe that we are in a moment that is very scary because we still have enough people with credit scores, and it's almost like a loaded weapon. People don't understand, they care more about impressing other people, so they try and buy things that they can't afford. They use credit and they spread the payments out longer. And what's going to happen is it's going to create a mini hyperinflation. Okay, that's been my thesis for years. And it seems to be playing out along the lines of what I've been saying for that long. And so when we have this little dip in the markets, the stock market, things like that, rates are going to dive down because banks are going to have problems. They already are right now. The Federal Reserve is out there pumping tons of money into banks right now because they're not trusting of each other. There's a lot of private credit and some public debt that is having some issues. And so when you start looking at these situations, I believe that the Fed is going to drop rates and then they're going to have to almost overnight, we're talking a handful of quarters, because inflation is going to just scream higher. They're going to have to raise rates. And I believe you're going to see a Paul Volcker moment. I've been calling for a 10% mortgage, and I believe that's going to happen. but not before a dip in the rates. You see, the other thing that people don't realize is, again, the Fed does not lower rates unless something is really broken, right? The Federal Reserve actually likes interest rates to be at a sort of steady amount. Typically, for a mortgage, is about between 6 and 7% historically. But the thing is, history was rewritten after 9/11, after the dot-com bust, and then the subsequent housing market bust. We have not seen normal rates uh, really in 25 years. Okay. Now, mortgages did hit a peak of around the same peak that we hit last year back in 2005, 2004. That was enough to take the market down and create one of the greatest recessions in history. But the problem is, because of all the funding that the Fed injected into the banking system to juice and boost the markets, you've had this artificial market in housing. The high-end homes are not selling. They are actually falling in price. The cheapest homes are selling right now only, like when you go look at starter homes from Lennar, Toll Brothers, and things like that, they are only selling because of the rate. What's not being told in this story is the rate is only one cost of four costs of a mortgage payment. You have the interest rate, so the mortgage amount that's owed to the bank each month. Then you've got the actual principal amount, which is very small in the beginning. And through an amortization schedule, it gets larger and larger part of your payment. But in the beginning, you're front-loaded interest. Then you've got your insurance. The insurance is absolutely skyrocketing. It's not going to get any better anytime soon. We're in a national crisis with insurance costs. And then fourth is your taxes. And of course, sometimes there's an HOA and stuff like that, but that's just your four portions of a mortgage. So people are now diving into these adjustable rate mortgages. And when rates correct to the upswing in this cycle, you're going to see a lot of people lose their homes. Now, that's not going to happen for another handful of years. But these arms have been growing, not just this year, but last year and about halfway into the year before, in 2024. 2023. So the thing is that if most people don't know what they're even doing when they get a mortgage. As a matter of fact, most people don't even know how to save thousands of dollars on a refi. They just go in and they pick a broker and they just go. It's usually a friend of a friend or a referral from a real estate agent, and they go get a mortgage, not knowing of all the little hidden costs and hidden fees in there. And like auto debt, a lot of people end up upside down in those short-term buys and sells just because of the cost of the mortgage. And that's where it's going to get really interesting in the future. So that's what I wanted to go over, is that you're going to start seeing, because some people cannot stop buying homes, and home sales are getting very scarce right now. Inventory has exploded. Prices are dropping. A lot of sellers are capitulating. Some sellers still don't even understand how bad the actual market is. And they're going to figure it out by this next spring, because this spring was not good. And if you noticed that when the Federal Reserve lowered rates just recently, mortgages went up. And the reason why the mortgage rates went up, because the Fed does not control it. The banks, it's still a free market. Banks that lend money, have pockets of money for mortgages. They're sitting there going, we don't think that people are going to be able to pay their mortgages soon, because the economy is on very shaky ground. So what they're doing is they're pricing these mortgages, trying to stay competitive with other lenders, but they're all sort of raising the bar in the prices, because there's now a lot more risk attached to the debt that they want to put out, the money they want to loan out. And so that's why you're seeing, when the Fed lowers rates, even though that rate is lower now for the bank to go and access that money to use that to lend into the market for mortgages, they're still putting a higher debt premium on, or risk premium, sorry, on that money. That's why mortgage rates aren't falling as much as you'd like them to be. Guys, if this makes sense, is this making sense to you? Type yes or no if it's helping or making sense. I'm just curious, because I think you're going to see a lot of people spend way too much. That's why I made that mortgage course. The sale link is down below. Our students are incredibly happy with it. I've never found a place in all the 25 years and all the mortgages I've had, and I put it together. I even had a broker come in of, I think, 27, 28 years of experience to teach that course. It's just been an amazing change for a lot of people. They go, I'm going to be able to use this information forever. And quite frankly, I couldn't make enough YouTube videos to cover all of that stuff. So anyway, I hope you got something out of this. Thank you so much for watching. The Economic Ninja is out.